Imagine you wake up, right? You grab your coffee, you check your terminal, and you see that a really prominent consumer tech company just posted like a 14.3% year-over-year revenue decline.
Yeah, which is usually a death knell.
Right. I mean, they lost a fifth of their paying user base.
Yeah.
Gone. And they took a $630 million hit to the chin on the Gap print.
Brutal.
So if you're just scanning the headlines, you're bracing for a bloodbath. You expect the stock to gap down 20% at the open.
Oh, at least 20%. You're looking for the exit.
Exactly.
Yeah.
But instead, the tape completely inverts. I mean, the stock rips 34.2% higher by the close of the next day.
It's wild.
And trading volume spikes to like 10 times the normal run rate.
Yeah.
We're talking roughly 34 million shares changing hands.
Just massive institutional rotation.
Yeah. And the options flow is screaming pure euphoria. Call buying surging over 400% above typical volumes. So welcome to Talk Tickers.
Glad to be here.
Today, we're tearing apart the mechanics of the most violent, counterintuitive market repricing of the quarter. We're looking at Bumble's Q4 2025 and full-year earnings print, which just hit the wire on March 11th.
And it was honestly a masterclass in market divergence.
Right, because retail and institutional read this totally differently.
Completely differently. This is the exact type of print that violently separates the retail momentum traders from the institutional heavyweights. Because if you were just trading off the top line decay and, the Jap noise, you got run over. Institutional buyers were aggressively bidding this up because they weren't looking at a shrinking company.
What were they looking at then?
They were looking at a management team that just successfully performed like open heart surgery on its own business model.
Wow.
Yeah, they entirely reset the baseline quality of the revenue.
Right, but if you're a portfolio manager trying to model this out right now, you have to reconcile the absolute ugliness of those surface level metrics with that institutional euphoria.
You do. You have to dig into the plumbing.
So let's start by ripping off the Band-Aid on the Gap numbers. They printed $224.2 million in revenue for the fourth quarter.
Which actually beat the lowered street consensus.
Yeah, it beat the 21.3 million consensus, but a 14.3% year-over-year decline is still, that's a massive top-line contraction.
It is. You can't ignore that.
And then there's the Gap diluted EPS, which came in at a staggering loss of $4.06 per share.
Right, but we have to contextualize that loss.
Well, yeah, it was driven almost entirely by this $630.5 million impairment charge.
Exactly.
Now, I know a goodwill impairment is just, a non-cash paper reality acknowledging past overvaluation. We all know how the accounting works.
Sure.
But the timing of taking a $630 million bath right now, it's what's fascinating to me. It feels like they're deliberately clearing the deck.
That is exactly how you have to read it.
Yep.
Management is they're kitchen sinking the legacy baggage.
Kitchen sinking it.
Yeah. When the market capitalization of the equity falls below the carrying value.
Which has been the reality for the entire dating sector over the last, 24 months?
Exactly. The whole sector has been compressed. So the auditors require you to write down that goodwill. But taking it all right now in this specific quarter is a massive signaling mechanism.
So
they're wiping the slate clean because they know the cash generation of the underlying business right now is pristine.
So the smart money just ignores the Gap loss.
Institutional investors back that $630 million out instantly. They don't care about a non-cash accounting adjustment stemming from, legacy private equity structuring.
Right.
They care about the fact that when you strip out that impairment, adjusted EPS came in at $1.07.
Which completely vaporized the street's consensus.
Yeah.
They were looking for 24 to 28 cents.
It was a massive beat.
Beating profitability expectations by that magnitude on a shrinking top line is it's wild. And it immediately forces us to look at the operating leverage.
Oh, the leverage is the whole story.
Because adjusted EBITDA hit $71.6 million. That's a 31.9% margin. To print a near 32% margin while your revenue's falling by double digits, that means your cost discipline is absolute.
It proves the fundamental elasticity of their cost structure.
Yeah.
And it sets up the single most crucial divergence in the entire earnings print. It's the exact fulcrum on which this 34% stock spike balances.
The user metrics.
You have to look at the user metrics. Total paying users fell by 20.5% year over year, dropping down to 3.3 million.
And normally, In a consumer subscription business, losing a fifth of your payers, that's a terminal diagnosis.
Ordinarily, yes, you'd panic. But at the exact same time that payer count cratered by 20%, the average revenue per paying user, the ARPPU,
Right.
it jumped 7.9% to $22.20.
Okay, let's stop right there and put this under the microscope, because this is where Wall Street is placing his bets. You don't accidentally lose 20% of your user base while simultaneously squeezing 8% more out of the ones who stay.
No, that is highly engineered.
It's engineered. And it brings us to this quality reset.
Yes.
The operational metric that absolutely floored me on this print was the marketing spend. They cut performance marketing by well over 80% year over year.
It's a staggering cut.
I mean, in consumer social, if you stop buying users at the top of the funnel, you usually enter a death spiral.
You fall off a cliff.
So how did Wall Street get comfortable that slashing ad spend by 80% wasn't just management, throwing in the towel?
Because of the underlying unit economics of the users they were actually acquiring, you have to understand the mechanics of performance marketing in the dating ecosystem right now.
Which is broken, right?
Totally broken.
Right.
With the changes to IDFA and the rising CPMs across Meta and TikTok, the customer acquisition cost has just skyrocketed.
Yeah.
If you're aggressively spending on performance marketing, you are effectively buying low-intent users.
What does a low-intent user look like in this context?
You're catching people who are casually scrolling, right?
Yeah.
They see a highly optimized ad. They download the app on a whim. Maybe they purchase a $5 consumable feature.
Like a single super swipe or
Exactly. And then they churn out 72 hours later.
Ah.
The LTV to CAC ratio, the lifetime value compared to the acquisition cost on those users, has become structurally unprofitable.
It's like a sauce company realizing their freemium SMB tier is bleeding cash.
That's exactly it.
You have this massive volume of users who submit support tickets, drain server bandwidth, and maybe pay you $10 a month, but they churn every 90 days.
Yeah.
Eventually, a smart management team pivots. They fire the unprofitable customers and focus entirely on the enterprise seats.
Right.
You lose the raw user count, but your margins explode. Or it's like a restaurant stopping its 2-for-1 coupon flyers to see who actually likes the food.
That is the perfect analogy. Management engineered a controlled burn of the top of the funnel.
A controlled burn.
Yeah, they stopped subsidizing the low-intent users. So yes, the total paying user count dropped to 3.3 million, but they successfully purged the system of those churn-heavy participants.
And the proof of that is in the monetization mix, right?
The structural proof is undeniable. The percentage of payers who are choosing actual recurring subscription tiers rather than just buying one-off consumables skyrocketed from 80% to 89%.
Which fundamentally changes the quality of the revenue.
Completely.
You're trading highly volatile, impulse-driven consumable revenue for predictable recurring subscription revenue.
Exactly. The revenue you lose from the top line is the lowest margin, lowest quality revenue in the business anyway.
Right.
And what shocked the sell side, the real reason the stock re-rated so violently, is that despite turning off 80% of the paid acquisition hose, the core organic engine didn't stall. App registrations and active users actually stabilized natively. Week 1 retention in the US is up materially.
Okay, if I'm a PM modeling this, I'm instantly asking why organic retention is up when marketing is down.
Right. It seems counterintuitive.
Is it just that the denominator shrunk so the average retention looks better? Or is there an actual network effect happening where the ecosystem is suddenly healthier because the low-intent users are gone?
It is absolutely the latter. When you remove the low-effort users, the people who swipe mindlessly but never send a message.
The ghosts.
The goats, exactly. Or the people who abandon conversations halfway through. When you remove them, the actual experience for the high-intent user improves.
The signal-to-noise ratio gets better.
Exactly. And when the product experience improves, retention extends. They proved that the brand has enough cultural gravity and inherent network effects to attract and retain high-value users without paying a massive tax to the social media ad duopoly.
But here's the friction point for me. They stabilized the foundation, they improved the revenue mix, but they did it while operating on an infrastructure that management openly admits is archaic.
Oh, it's ancient.
Right. If you read between the lines on the technical commentary, their current backend is fraught with legacy tech debt.
Yeah.
It's monolithic, it's slow to deploy, and it doesn't allow for the kind of rapid algorithmic personalization that the market demands right now.
Not at all.
Which forces us to look at the massive operational risk and the upcoming catalyst. the Q2 2026 launch of Tech Stack 2.0.
And this is the pivot from stabilization to acceleration. Over the past year, they have essentially been rebuilding the engine while the plane is still in the air.
Which is terrifying.
It is, but they've stood up a completely new engineering-led innovation hub down in Austin, Texas.
Okay.
They are migrating away from legacy on-premise style infrastructure to a fully cloud-native microservices-based architecture.
Let's talk about the immediate P&L impact of that, because there is a margin story hidden in the infrastructure migration.
Absolutely.
If you're running legacy data centers while simultaneously standing up a massive cloud-native architecture on AWS or GCP, you're paying for both.
Precisely. Right now, they are carrying duplicative compute costs.
Yeah.
They have to keep the legacy servers running flawlessly to support the millions of active daily users on the current app while simultaneously funding the development, the testing, and the cloud hosting for Tech Stack 2.0.
That's a massive drag on the current cost of revenue and operating expenses.
It is.
So when they flip the switch in Q2 and fully migrate, they get to deprecate those old legacy systems.
Gone.
Those parallel data center costs vanish. So that's a direct mechanical tailwind to the operating margins in the back half of the year, completely independent of user growth.
It's a structural margin unlock. But, the market isn't just pricing and server efficiency.
Right.
The reason this migration matters is what the cloud-native architecture actually enables on the product side. And this leads to the most explosive revelation from the call, the explicit exploration of life beyond the swipe.
Which is a tectonic shift. I mean, for a company that literally helped define the gamification of modern dating.
They practically invented it.
The binary left-right swipe has been the golden goose of engagement for a decade. Why kill it?
Because the data shows that the golden goose is exhausted. The industry is hitting a wall with swipe fatigue.
Just burning out.
Yeah, the fundamental problem with the swipe mechanism is that it commoditizes human connection.
Right.
It forces users to make split-second binary judgments based almost entirely on a flat, two-dimensional image. It creates a slot machine psychology.
Which feels good in the moment.
Users swipe mindlessly to get the dopamine hit of a match, but there's zero underlying intent.
Which leads to the exact phenomenon management describes so perfectly, dead-end chat zones.
Yes.
You end up with an inbox full of 50 matches, but nobody initiates a conversation because the friction of moving from a superficial swipe to a meaningful dialogue is just too high.
Exactly.
If the velocity of your platform ends in a dead chat, the product is failing.
And that failure leads directly to churn. If users aren't going on dates, they leave. So Tech Stack 2.0 is fundamentally designed to dismantle that commoditization.
Yeah.
Because they're moving to a more agile backend, they can introduce what they're calling chapter-based profiles.
I want to dig into the psychology of this. A chapter-based profile moves away from the static primary photo and generic bio.
Right.
It forces a dynamic, narrative-driven presentation. You're essentially demanding a higher level of upfront investment from the user creating the profile.
Much higher.
From a behavioral economic standpoint, adding friction to the onboarding process usually kills conversion.
Usually, yeah.
Why are they actively adding friction?
Because it acts as a very necessary filter. If you add friction to profile creation, you immediately weed out the low-effort actors.
The empty calories.
The empty calories. The people who just want a quick ego boost won't take the time to build a chapter-based narrative. The users who do complete it are signaling high intent. And for the person viewing the profile, it provides dramatically stronger compatibility signal.
You aren't just engaging with a face, you're engaging with context.
Exactly.
And they're building specific UI mechanics to bridge that gap from the screen to the real world.
Yes, like the really into you tab.
Which is a much stronger, costlier signal of interest than a standard right swipe.
It takes more effort.
But the feature that stood out the most to me is the suggest a date function. This feels like an explicit attempt to force velocity.
It is. Suggest a date lowers the conversational friction. The hardest part of dating app interactions is the pivot from digital banter to actually coordinating a real-world meeting.
Nobody wants to make the first move to schedule.
Right. By building that workflow directly into the platform architecture, they're accelerating the time to value for the user.
Because ultimately, the only metric that matters for long-term retention in this space is real-world success.
That's it. If they meet offline, they have a good experience. If they have a good experience, the brand equity compounds, and you don't need to spend 80% of your budget on performance marketing.
But none of this hyper-personalization, none of this matching velocity works without an incredibly sophisticated data layer underneath it,
Not at all.
which forces us to look at the AI strategy. Now, I have to play the skeptic here.
Please do.
If I'm sitting on an investment committee and a PM comes to me pitching a company because they have quote unquote AI matchmaking, I'm laughing them out of the room.
Oh, yeah. Everyone says they have AI.
Right. Every SaaS platform, every consumer app, every smart refrigerator is slapping the letters AI onto their investor deck right now to try and catch a multiple expansion.
It's a buzzword.
So why should we believe that Bumble's AI integration is an actual structural disruptor and not just a commoditized API wrapper?
The skepticism is completely warranted. And the distinction you have to draw here is the difference between the model and the moat. The actual generative AI technology, the foundational large language models, those are rapidly becoming a commodity.
Right. The compute is cheap.
Anyone with capital can license an API from OpenAI, Anthropic, or utilize an open source model. The algorithmic compute is not the competitive advantage anymore.
So it is.
The true alpha, the actual unassailable moat, is the proprietary dataset that feeds and fine-tunes the model.
It's the exact same dynamic as alternative data in quantitative trading.
Perfectly said.
Everyone has access to the same algorithmic trading software.
Mm-hmm.
The hedge fund that wins is the one that buys exclusive proprietary credit card receipt data or satellite imagery that nobody else has.
Right.
The model is dumb without the data.
Precisely. And think about the depth and the density of the data set Bumble has aggregated over the last decade.
It's got to be massive.
They don't just have basic demographic data. They have a pristine, highly structured, psychologically dense interaction log of human romantic intent.
They know exactly how people talk.
They know the exact conversational cadence that leads to a successful date. They know at what specific inflection point in a chat a user loses interest. They know what sequence of photos correlates with long-term retention versus immediate rejection.
And you can't scrape that data from the public internet.
You can't. You cannot train an AI to understand the nuances of human attraction, rejection, and compatibility by feeding it Wikipedia pages or Reddit threads.
A startup could raise $100 million tomorrow, build a beautiful app, license GPT-4, and they would still fail, because their AI has no historical context on how humans actually behave when they are vulnerable.
Exactly. The cold start problem is insurmountable, and Bumble is deploying this proprietary data moat through their upcoming AI assistant, which they're calling B.
Just the letter B.
Yeah. And it's not designed to be a generic chatbot that you casually talk to for entertainment.
Right.
It's architected to be a hyper-personalized matchmaker that operates in the background. As you interact with it in private environments, it learns your communication style, your non-negotiable values, and your actual relationship goals.
Which, let's be honest, often differ drastically from what users explicitly state on their public profiles.
Exactly. People lie on their profiles, but they are honest in their behavior. The AI learns from the behavior. It then uses that nuanced understanding to curate your feed.
So it fundamentally inverts the traditional search paradigm.
Completely.
Instead of giving the user a massive, overwhelming catalog of thousands of potential matches and forcing them to apply superficial filters, the AI acts as a curator.
Yes.
It prioritizes a very small number of highly compatible connections. It's the ultimate manifestation of the quality reset we talked about earlier. Quality over quantity baked directly into the code.
But the AI strategy is only half the demographic equation.
What's the other half?
The most profound observation management made on this call wasn't about technology, it was about sociology. They noted a massive structural shift in how Gen Z behaves compared to millennials.
This is crucial. I mean, the entire dating app industry was built on a millennial behavioral framework.
It was.
The millennial experience is highly structured and highly individualized. Two people match, they text for 3 days, they meet at a coffee shop for a 45-minute interview to see if they like each other.
A formal interview.
Yeah, it's a one-to-one gamified process.
And Gen Z completely rejects that architecture.
So what do they do?
Gen Z approaches connection through community. They prefer asynchronous, lower-pressure group settings where relationships form more organically.
Like as a byproduct of shared interests.
Exactly. Rather than forced, high-pressure, one-to-one interviews.
And this is where the acquisition of Geneva suddenly makes perfect strategic sense.
You nailed it. Geneva built incredible, robust infrastructure for group chat and community organizing. Bumble bought them, and now they're integrating that tech stack into Bumble BFF and their broader ecosystem.
We're already seeing the leading indicators of this strategy working, aren't we?
We are. Following a recent discoverability update to the group features, active groups surged 17% in just 2 weeks.
A 17% spike in 2 weeks for a mature consumer platform is explosive.
It proves the latent demand for community-led interaction is massive.
And look at the unit economics of this strategy. It is the ultimate top-of-funnel hack.
Oh, it's brilliant.
You bring Gen Z into the ecosystem not by advertising a dating app, but by providing the infrastructure for their local run club, or their intramural volleyball team, or their professional networking group.
Right. They download the app for the community utility.
And you completely bypass the stigma and the friction associated with downloading a dating app because you're lonely.
The customer acquisition cost plummets to near zero.
Because the community organizers are doing the acquisition for you.
Exactly. And once they're inside the ecosystem, the walls between friendship, community, and romantic intent become fluid.
The app that organizes your trivia night is the same app that quietly introduces you to your future spouse.
That is a structural demographic advantage that their legacy competitors are fundamentally lacking right now.
It is a brilliant product evolution. But while the product and engineering teams have been laying the groundwork for Q2, the CFO has been executing an absolute masterclass in financial engineering and balance sheet optimization behind the scenes.
Oh, the balance sheet work is incredible.
We need to pivot to the margin hack.
Yeah.
Because there was a detail buried in the call that has staggering implications for free cash flow.
The alternative billing.
It's all about alternative billing, the Apple Pay catalyst.
Yeah.
And if you're a PM, this is the kind of mechanical plumbing detail that gets you incredibly bullish.
It's pure margin.
Historically, mobile consumer subscription businesses have been held hostage by the App Store duopoly. Apple and Google levy a massive tax up to 30% on any in-app purchase or recurring subscription.
That's 30% of top-line revenue instantly vaporized.
Before it ever hits the gross margin line.
It's an exorbitant toll, but the global regulatory environment has shifted violently against that model. Following the fallout from the Epic Games litigation and the implementation of the Digital Markets Act in Europe, Apple has been forced to loosen its steering rules.
They have to allow alternative direct billing methods in specific regions now.
Most notably the U.S.
So, Bumble has aggressively moved to bypass the Apple tax. They've integrated direct payment routing using Apple Pay on the U.S. iOS platform. Now, mechanically, how does this work? Because if I'm a PM, my immediate fear is conversion friction.
Sure.
If you force a user to leave the app ecosystem, go to a mobile browser, and manually type in a 16-digit credit card number, your checkout abandonment rate is going to skyrocket.
Oh, it would be disaster.
You might save on the 30% fee, but you lose 40% of the volume.
But that is the genius of using Apple Pay as the alternative billing rail.
Yeah.
The user experience remains almost entirely frictionless.
Really?
Yeah, it still utilizes the biometric authentication, the double click of the side button, the Face ID, but the actual mechanical routing of the transaction completely bypasses Apple's proprietary in-app purchase engine. Instead of Apple processing the payment and taking 30%, the transaction is routed directly to Bumble's payment processor via the Apple Pay web protocol.
Which only charges, what, a standard interchange and processing fee of roughly 2 to 3%.
Exactly.
The arbitrage there is breathtaking.
Yeah.
You are legally recovering 25 to 27 percentage points of margin on every single transaction routed through that channel.
And the adoption velocity is stunning. Management disclosed that this alternative billing routing alone mechanically added 1 full percentage point to the company's consolidated gross margins in the fourth quarter.
In just 1 quarter.
And that's just the tip of the spear. They explicitly stated that in Q1 of 2026, over 50% of U.S. iOS payments have already adopted this direct payment method.
That is pure, unadulterated free cash flow dropping straight to the bottom line.
It requires 0 new product innovation,
Right.
0 additional marketing spend, and 0 new users. It is purely a mechanical routing optimization that structurally, permanently elevates the gross margin profile of the business.
And you can see the results of that rigorous financial discipline in the cash flow statement.
But cash flow is beautiful.
Despite the GAAP net income loss we talked about, the business generated $250.4 million in operating cash flow for the full year and a massive $239 million in free cash flow. They're converting EBITDA to free cash flow at an elite rate. and they are deploying that capital very strategically to de-risk the balance sheet.
Which brings us to the TRA buyout.
Yes, they deployed $186 million in cash during Q4 to completely eliminate their tax receivable agreement liability.
This is huge.
For the listeners modeling this, the mechanics of a TRA can be incredibly convoluted. Walk us through why spending $186 million to buy this out was the smartest capital allocation decision the CFO could have made.
Okay, so a tax receivable agreement is essentially a phantom limb left over from private equity ownership.
Okay.
When a company is carved out of private equity and taken public, the restructuring often creates massive deferred tax assets.
Essentially, legal loopholes that allow the new public company to shield its future income from taxes.
Exactly. But the private equity sponsors aren't going to just give those tax shields away for free.
Obviously not.
They structure a TRA, which legally mandates that the public company must pay the pre-IPO owners a vast majority, typically 85% of the actual cash savings generated by those tax breaks.
So it acts as a persistent parasitic drag on cash flow.
Exactly. Every time the operating business succeeds and saves cash on its tax bill, it has to immediately cut a massive check to the legacy private equity owners.
It depresses your free cash flow yield and makes the capital structure overly complex for the buy side to model.
It's a perpetual liability. By utilizing $186 million of their cash stockpile to buy out the entirety of that agreement right now, management permanently severed the cord.
Going forward, Bumble retains 100% of the economic benefit of those tax assets.
It instantly simplifies the balance sheet, permanently increases the future free cash flow conversion rate, and cleans up the narrative for institutional investors.
It's the ultimate financial house cleaning.
Yes.
And the timing is critical because they're staring down a looming debt wall.
The 2027 term loan.
Yeah. They have $588.5 million in term loan debt coming due in January 2027. Usually when a consumer tech company has $500 million in debt maturing in less than 12 months, the credit markets start pricing in severe distress.
You see equity multiples compress.
Right, as the market fears a highly diluted refinancing or a liquidity crunch. But the CFO was incredibly nonchalant about this maturity.
Because the balance sheet is pristine. They are sitting on $175.8 million in cash even after the TRA buyout.
They generated $239 million in free cash flow this year.
The CFO's stated strategy is to take a portion of the cash on hand, pay down a chunk of the principal to inherently deleverage the business, and simply refinance the remaining balance.
You don't project that level of certainty on a public earnings call unless you've already run this shadow book building process with the credit market.
Exactly. They know the appetite is there.
A syndicate of banks looks at a business printing near 32% EBITDA margins, generating massive cash flow with a newly cleaned up TRA and expanding gross margins from Apple Pay.
They will trip over themselves to roll that paper over at favorable terms. The balance sheet risk is effectively zero.
So when you aggregate all of these components, the operational quality reset, the margin expansion from alternative billing, the de-risked balance sheet, and the impending Q2 product catalyst, you finally had the context to understand the Q1 2026 guidance and the violent 34% stock reaction.
Right. Let's break down that guidance. For Q1, they're forecasting total revenue of $209 million to $213 million, and adjusted EBITDA of $76 million to $80 million.
If you run the math on the midpoint of that guidance, it implies an adjusted EBITDA margin of roughly 37%.
It's huge.
37%. They printed 31.9% in Q4, and they're immediately guiding to 37% in Q1.
The Apple Pay margin hack and the deprecation of duplicative tech costs are flowing through the P&L faster than anyone modeled.
But if revenue is still theoretically guided flat to down, why did Morgan Stanley upgrade the stock? Why did institutional buyers aggressively sweep the order book?
Because the institutional buy side operates entirely on forward-looking mechanics. The thesis driving the stock relies on a concept we call the lag effect.
Explain the plumbing of that lag.
When you execute a quality reset and cut your cheap marketing, your raw user count drops instantly. That impacts the current quarter's top line immediately,
Right.
But the high-intent users who remain and the new organic users joining are structurally stickier. They don't churn in 7 days, they retain for 4, 5, 6 months.
The lifetime value of those cohorts is vastly superior.
But because subscription revenue is recognized ratably over time, that compounding LTV takes several quarters to actually steepen the revenue curve.
The stabilization of active users. and the 8% spike in ARPPU are the leading indicators.
Exactly. The gap revenue is the lagging indicator. The smart money looked at the Q4 data, saw the leading indicators inflect violently positive, and realized that a massive revenue reacceleration in the back half of 2026 is mathematically baked in.
They're buying the stock at a discount now, because if you wait for the revenue growth to actually print on the income statement in Q3, the multiple will have already expanded, and you miss the trade.
Exactly. The market is pre-pricing the success of Tech Stack 2.0, but, we have to remain objective here. This trade is not without massive execution risk, and the sell side is rightly pointing that out.
Yeah, you saw Jefferies put out a very cautious note, warning that the dating category has seen multiple false starts over the last few years. Bank of America maintained an underperform rating.
And the skepticism from the bears is entirely rational.
The bear thesis is simple. Congratulations on expanding your margins and stabilizing retention, but your total paying user base is still fundamentally smaller than it was 24 months ago.
Right. You have successfully engineered a smaller, highly profitable niche business.
If the Austin engineering team launches Tech Stack 2.0 in Q2 and chapter-based profiles and AI matchmaking fail to re-accelerate absolute payer growth, then the company is permanently range-bound.
The margin expansion story has a terminal velocity. You can only cut costs and optimize billing routing so much. Eventually, you have to grow the top line.
If the new features don't resonate with Gen Z, or if the psychological barrier of swipe fatigue is too deeply entrenched in consumer behavior to be fixed by UI changes,
then this entire 34% stock pop is a massive, liquidity-driven head fake.
the burden of proof is entirely shifted. The finance team executed flawlessly. The marketing team took their medicine. Now, it is 100% on the product and engineering teams to deliver an architecture that fundamentally alters consumer behavior.
They've set the table perfectly, but now they actually have to serve the meal in Q2.
All right, this brings us to the culmination of our analysis. We are transitioning into our signature segment. This is not financial advice.
My favorite part.
We are strictly looking at the data, analyzing the structural plumbing of the market, and exploring the outer bounds of what is mathematically possible. So, set the scene for us. You're a senior analyst at a major hedge fund. You have 10 minutes to pitch the investment committee on a structural options trade. Give us the outrageous but plausible pitch for Bumble.
All right, lock the doors, look at the terminal. I am pitching the AI data monopoly buyout.
Okay, I'm listening.
The fundamental mispricing in the market right now is categorization. The street is valuing this asset as a legacy, slow-growth consumer dating application. That framework is obsolete.
So what is it?
We are no longer looking at a dating app. We are looking at one of the world's most pristine, highly structured, psychologically dense data sets of human romantic, social, and behavioral intent.
The unassailable interaction data moat.
Precisely. Now look at the macro landscape. Who needs that exact data set desperately?
Mega cap tech conglomerates that are currently locked in an arms race to dominate the future of social and generative AI.
Look directly at Meta, or even Alphabet. Meta has a monopoly on general social graph data, but their historical attempts to build native, highly nuanced dating or deep intent platforms have largely failed.
Yeah.
Meta is aggressively pivoting their entire corporate strategy toward highly personalized AI assistants. If you want to build an AI that genuinely understands human emotion, nuance, rejection, attraction, and community dynamics, you cannot train it on sanitized public internet text.
You need the raw, unvarnished interaction logs of millions of humans actively trying to form connections.
Bumble is sitting on a decade of that exact telemetry. It is the ultimate plug-and-play acquisition target for a Meta looking to inject deep human behavioral understanding into their LLMs.
And look at how perfectly the asset is being prepped for acquisition right now.
The foundational M&A friction is being systematically eliminated. The tech stack is migrating to a cloud-native microservices architecture in Q2, which means it can be seamlessly integrated into any mega-cap acquirer's infrastructure.
The balance sheet is impeccably clean. The messy private equity TRA is entirely bought out. The cash flow conversion is elite, and the debt is easily manageable by any large acquirer.
Furthermore, the brand is globally recognized and definitively female first, which carries immense cultural goodwill and brand safety for an acquirer like Meta.
It is a perfectly packaged, mathematically clean asset ready to be bolted onto a trillion-dollar ecosystem. So how do we structure the actual trade to capture this alpha without taking on the systemic risk of the dating sector?
We construct a delta-neutral multi-leg options strategy that isolates the specific execution and M&A premium. First, we aggressively sell out-of-the-money put options on Bumble equity. Because implied volatility is still elevated following the earnings print, the premium we collect is substantial. By selling these puts, we are effectively getting paid upfront to express our willingness to acquire the stock at a steep discount if there's near-term macroeconomic volatility.
We take that massive premium from the short puts, and we use it to finance the long side of the trade.
Exactly. We deploy that premium to purchase January 2027 out-of-the-money LEAP PS call options on Bumble.
Long-term equity anticipation securities.
Yes. By using LEAP PS, we secure massive asymmetric upside exposure for over a year and a half. This duration mitigates the theta decay that crushes short-term options traders. We're giving ourselves an enormous runway.
We're essentially getting paid to wait.
Right. We hold the leap yes and wait for one of two catalysts. Either the structural revenue reacceleration hits the tape in Q3 or Q4, fueled by the Tech Stack 2.0 launch, or an outright acquisition announcement drops on a random Tuesday morning.
But we cannot leave the beta unhedged. The systemic risk here is that the entire online dating sector slowly bleeds out due to broader macroeconomic pressures or terminal consumer fatigue. We do not want to hold that systemic bag.
No, we don't. So we pair our long Bumble EPS by aggressively shorting Match Group equity.
That is a phenomenal classic pair trade structure. By carrying a short position in Match Group, we completely neutralize the broader dating sector beta.
Exactly. If the entire industry contracts, our Match short prints money and covers any potential theta bleed or losses on the Bumble leaps.
We are purely surgically isolating Bumble's idiosyncratic execution alpha and its unique M&A data premium. We are betting solely on Bumble's specific foundational turnaround and its hidden value as a pristine AI dataset, completely insulated from the broader sector noise.
It is a highly structured, risk-defined bet on management execution and the hidden value of proprietary data in an AI-driven world.
That is an incredibly tight, entirely plausible pitch. Let's recap the mechanics we just dissected.
Sure.
We started with a tape that looked utterly broken on the surface, but was actually reflecting a brutal, necessary, and mathematically sound quality reset. We explored the massive structural margin unlocks happening quietly in the background via alternative billing routing like Apple Pay.
The plumbing optimizations.
Right. We analyzed the complete overhaul of the company's financial foundation, utilizing pristine free cash flow to clear out legacy tech debt and eliminate parasitic pre-IPO tax liabilities.
Which was huge.
And we are now staring down the barrel of an impending Q2 launch of a fundamentally reimagined platform, Tech Stack 2.0, that could effectively kill the swipe, introduce high-intent chapter-based storytelling, and leverage a proprietary AI data mode to push Gen Z into real-world group dates.
It's a textbook turnaround setup, provided the engineering execution in Austin over the next 90 days matches the financial ambition we saw in this print. They have traded the low-intent, low-margin volume for high-intent, highly monetizable stickiness.
Before we sign off, a mandatory reminder that absolutely none of this is financial advice. This discussion is purely for educational and entertainment purposes.
We are just two people reading the tape.
Analyzing the structural plumbing of the market and exploring the mechanics of corporate strategy. We invite you to subscribe, and we want to hear your analysis. Drop your thoughts on the structural future of the dating sector, the hidden value of AI interaction data, or your own options pair trade ideas in the comments or via email.
It is a phenomenal sector to monitor, sitting right at the absolute intersection of behavioral psychology, cloud infrastructure, and financial engineering.
It truly is. It brings me back to the jarring dichotomy we started with. A 20% drop in active users, a $630 million accounting bath, and a stock that violently re-rates 24% higher.
The market looks forward.
It just goes to show you, in the institutional markets, sometimes the most valuable and profitable thing a management team can do isn't acquiring a new customer, but having the absolute courage to walk away from the unprofitable ones. Keep your eyes on the tape. We'll see you next time.